This is Professor Bolt, and this video is to help you with content on Exam 1, meant as a study guide and a review session. Exam 1 in BADM 212, and the course is Managerial Accounting. A lot of cost accounting. It's the second accounting course at the Citadel. So Exam 1 will contain information from chapters 1, 2, and 3. Chapter 1 is basically a strong overview of all of the definitions that are important for the text. And then chapter 2 and 3 go deeply into job costing. And job costs are the very first introduction that we have to manufacturing environment and the way the accounting is done for manufacturing. So just as a reminder, manufacturing is more difficult than a service industry like a consulting company or than a retail industry like Walmart or someplace. But we're talking about manufacturing. This is where a Boeing or Ford Motor Company manufactures a product that they sell. And so as a result, the complications include the fact that we are actually producing a product from raw materials. So there's a lot of processes that we have to deal with. And we're starting off with the job order costing component of this. So the textbook we're using is Garrison, Noreen, and Brewer. And let's get started. This review guide that I have prepared, I'm just going to go through just as if we were in class. And the first most important note that I have to remind you is that this is a college course. And in a college course, we are going into application, not definitions. So the idea is that your education has to be one that allows you to understand and apply information, not just memorize definitions. So we're all fortunate. We have cell phones, laptops, tablets, and if we want to know what overhead, materials, and labor are, then we can look that up. However, in this college course, we're going to be showing how we apply those. So instead of saying define overhead, sometimes called manufacturing overhead, in a college course, instead of saying which of the following is the definition, instead as an application we might say how do you calculate overhead? Or a question might say which of the following costs is an overhead cost? So let's go through this list, see if I can help you one by one. A lot of narrative, and hopefully we'll give you some good information to help you study for the test. First, we're talking about the cost of a product, and there are 3 product costs. Overhead, sometimes called manufacturing overhead. Materials, direct materials. These are materials that are easy to trace. And labor, this is the labor cost that's easy to trace. And as we said, if you recall from the very first, it's interesting that these are all expenses, but they all start on the balance sheet as inventory because now they don't become an expense until they're sold. So you spend money, you pay for expenses, you pay for costs, for labor and materials and overhead, and you combine these products and, you combine these costs and produce a product, and then that product is sold and it becomes an expense. So go back in your chapter, look at the PowerPoints that you have under SitLearn. They're not narrated, sorry. And remember how the costs flow. So first we have to do, yes, I am licensed, it does this all the time, sorry. First what we have to do is understand that there are 3 inventory accounts, and these are items that appear on a balance sheet because they're an asset. And these balance sheet accounts are the inventories that flow through for the job costs in manufacturing accounting. So overhead, if you can recall the definition, let's go back to this one. Overhead is a cost that is not convenient or easy or cost-effective to trace. Materials and labor, these are expenses or costs that it is easy, convenient for an individual to trace. So this overhead means it's an indirect cost. That's a second definition for it. And I'm going to plop straight down to here to remind you that what we have is that a direct cost is the materials and labor, because they are called direct materials and direct labor. Indirect costs are overhead. So you might want to put in your notes that overhead is the indirect cost. And again, because we know that accounting for manufacturing, for managerial accounting, doesn't really have any rules. It's up to the company. So as we said in the very first chapter, a company like McDonald's will consider pickles to be a direct cost of production, whereas a company such as the old-fashioned ice cream or Moe's Crosstown might consider those pickles to be an indirect cost and part of the overhead if they were to be a company that did actually trace the costs. So let's move back and talk a bit again about these three job costs and focus on the fact that first we start with direct materials, and then we add direct labor and overhead, and it goes into our work in process, and work in process is just the product that is being produced. From there, once we finish producing it, it goes into finished goods, typically ready to be sold, and it is on the balance sheet. These are all inventory accounts in the balance sheet. And hopefully you will remember that it goes next to the income statement, and on the income statement it is considered cost of goods sold. And as some of you recall, I had some trouble with making sure that everyone understood that cost of goods sold is an expense, just like the expenses you studied in 211. So as I'm going through this review session, by the way, I'm going to be trying to make it a more easy to understand format. So bear with me as I make some changes from time to time on the template that I'm using. So next we're going to talk about this gig that we have up here with overhead. Understanding that overhead is a difficult cost and has to be applied using a rate. It's called a predetermined rate or predetermined overhead rate, both terms. And hopefully you've got that formula, and that formula is estimated overhead. Let's see if I can do this. Divided by, oh, that's not the right one. Can't remember how to do the divided by sign. Divided by estimated cost driver. And so we come up with this rate. And so the rate may be that, hey, every hour that the employees work, we're going to charge $5 worth of overhead. Just like for every hour you go get your car repaired, they will charge you overhead. All depends on the company as to what overhead rate they use. And this formula that I just reminded you of is used quite frequently in your homework. It will be used many times on the exam. So what is this estimated cost driver? If you look in the next, we've got that a cost driver is also an activity base. And this is what we have determined, we being the company. What the company has decided drives costs. So if they feel like the more products they make, the more costs go up, good. But you may have something like a truck, and you would find that overhead is going to be allocated based on the number of miles that truck drives. Or you might have machinery that you want to allocate the overhead associated with that machinery. Think about Tesla. And they may track how many hours the machinery runs. And so that's your activity base or cost driver. They're the same thing. Both of them are used in but remember that this is where the cost driver comes from. So this term right here is what we're talking about in this respect, and that's something that's going to be given to you. So I'm going to actually move right down and pull this up. Let's see if you can remember what this is. When we use this formula, I'm going to pull this formula out so you can remember this important formula. Estimated overhead is sometimes done this way. The use of y equals a plus bx is the way we calculate estimated overhead. Sorry. Where y is equal to estimated overhead, and it is a component of fixed costs here and variable costs here. And x is considered the activity driver that we have estimated. So let's pull up this one definition where I've asked that you need to understand the difference in fixed and variable cost. So fixed cost is a cost that does not change whenever you are within the relevant range, within a certain level of activity. Fixed costs stay the same, but variable costs go up the more you produce. So let's take a very simple place like McDonald's. The fixed cost is the cost of the rent, and no matter how many customers you serve, the rent costs the same. Variable cost, however, goes up. The more hamburgers you make, the bigger your variable costs, because it varies per product. Now, there's another relationship, and this is one that students frequently have trouble with, so go in there and find it in your notes, because I told you to write it down, and that is that fixed costs stay the same within the relevant range. You should remember what that means. That means that, for example, McDonald's could not serve 10,000 customers a day in that one McDonald's hamburger place down the street from the Citadel. So there's a relevant range where outside of it you have to have bigger fixed costs. A bigger restaurant, more equipment, bigger drive-throughs, etc. And so fixed costs stay the same in total, but the more customers you serve, fixed cost per unit goes down. So if you only serve one customer a month and your rent is $1,000, wow, that's $1,000 in fixed costs per customer. But if you serve 1,000 customers and your fixed costs are $1,000, that's $1 a customer. So it's important to understand the difference in total and unit. And here we are. Let's pull this down here and talk about that in association with this. Moving to variable cost. A variable cost varies with production or activity. The more hamburgers you produce, the more buns going to cost, the more hamburgers going to cost, the more pickles and onions and paper to wrap it and packaging and everything. So variable costs stay the same per unit but get larger in total. Meaning it costs the same for each burger that we're manufacturing, but the total cost of all the burgers is going to go up the more you produce. Fixed costs are quite the opposite. Fixed costs stay the same in total, but the unit cost goes down the more units you produce. Hopefully that makes sense. If not, then you can take a pause, pull out your textbook, and see if you can find where we covered that. I believe it was in chapter 1 or 2. I think chapter 1. Okay, I'm back. I pulled out my textbook, and this is covered on page 30 and 31 of chapter 1. So let's move forward and talk about calculating product costs, because these are all connected topics. So product cost is actually equal to direct materials plus direct labor plus overhead. Sound familiar? So you can say, what are the total direct materials, direct labor, and overhead for the product that I am making? And let's say that you are making, you are a manufacturer of tables, and that you manufacture a batch of tables, and there's 100 of them in the batch. So a valid question, and there's one on the exam, would be, what is the total cost for materials, labor, and overhead for this batch of tables? And then if I tell you you made 100 tables, then I might ask you also for the unit cost. And then you would take the total cost divided by 100 tables. Let me throw this in here, and that is, this is a good time for us to talk about product and period costs. So these product costs right here, same thing. These product costs are materials, labor, and overhead. A period cost is defined as the SAG, selling, administrative, and general. The selling costs would be advertising or sales commissions, or admin might be human resources cost related. General expenses might be something related to the IT. Just depends on how they're classified. But they are not associated directly with the product or even indirectly with the product like overhead. And that takes us straight into this definition. A direct cost, easy to trace, convenient, not expensive. Indirect costs are not convenient or easy to trace. Let's move on down. I know a lot of talking. Sorry. Hopefully you can pause this video because it looks like we're at about, where's my video time? 15 minutes. Okay, conversion costs and prime costs. I could have you look that up, but let me just give it to you. Direct labor plus direct materials. Whoops, I just did that one wrong. Let's talk about conversion costs. Direct labor plus overhead. And prime costs are the ones that are easy to trace. Direct labor plus direct materials. So what we're talking about here is something we'll use in Chapter 4. And that is the cost to convert our materials. So it takes labor and overhead to convert our materials. Remember, too, that materials are a type of inventory. Look also at this. It's interesting. Direct labor is both a conversion and a prime cost. Okay, think we have already covered what happens to this. This is the example that I gave you to look up on page 30. So I get to move that one up there and skip on over. Let's see, cost flow. I believe we've covered this to an extent. We said the materials, to those we add conversion costs, and it all goes into work in process, and from there it goes to finished goods, and then once it's sold, it goes to cost of goods sold. If you want to see how this relationship works, please look at the PowerPoints from Chapter 2 and put them in slide mode so you can see the way the arrows move to show the transactions moving through the different types of inventory accounts. Almost at the bottom. Job cost sheets are charts that keep up with the cost per job. So if we have a contractor, that contractor will keep up with the cost with each job. They may be making 2 or 3 houses at a time, and this accumulates our materials, labor, and overhead. Moving down through here, calculating estimated overhead. Let's see. I'm going to move this one to the bottom, and let's talk about calculating estimated overhead. The most important and the most crucial thing to think of here is this is an estimate, and I'm moving right back up here. Here's the definition. Oops, let's see. Moving up here to say if you were asked to calculate estimated overhead, you will use this formula. And that is the estimated overhead divided by the estimated cost driver. It's an estimate. It means that at the beginning of the year we wanted to see how much we think we're going to have in overhead and how much we think we're going to have in our cost driver. And we will actually apply overhead based on actual data. So we might find that we had too much overhead that we estimated, or we had too much of our cost driver that we estimated, and we will determine our over and under applied overhead at the end of the period to see if we did a good job or not. So if your estimate says that you're supposed to have $10,000 worth of overhead, and in fact you have $12,000 worth of overhead in actuality, so again the estimate is 10 and the actual is 12, that means that you are 2,000 under, and that's not a good thing because that means you're going to have higher costs and less net income. So under applying overhead, not the best thing in the world because you didn't have the right costs associated with your job and you might lose money in the end. Definitely your net income will be lower. For over-applied overhead, that typically makes us happy. We overestimated what we thought we were going to spend, and so we made more money than we thought. But sometimes in the sales world, you lose customers because you estimated that your job was going to cost too much. Moving on. We did this in Chapter 2, and that is calculating cost of goods sold when you're given the cost of goods manufactured and beginning and ending inventory. So let's look at that formula here. It's beginning inventory plus additions. Sometimes that's purchases. Sometimes that's additions to work in process, additions to finished goods. And then we say that is equal to goods available. And if we subtract out, that should be a minus, ending inventory. That's going to equal to our remaining balance. In this case, it would be cost of goods sold. So if we look at the beginning finished goods and how much we manufactured, that tells us the goods available that we've had to sell. If we subtract that out with what's left over in ending finished goods, we will find out how much we actually sold. And that is a problem on most exams that we will be giving. That also deals with cost of goods manufactured. So I'm going to move this one up. Cost of goods manufactured is what is our addition. So the addition here is actually something that we will think of as the cost of the goods manufactured when we're talking about finished goods. A couple more definitions in here. Depreciation on factory equipment. A lot of students have trouble with this one. That is a period, that is not a period cost. I even have a bad template. That's bad. That is a product cost. And in fact, it is overhead and has to be allocated because it's really hard to think about how much depreciation does it take to manufacture one Tesla, because it's mostly robotics and they calculate depreciation as the cost of the robotics. The relevant range. So what is the relevant range? That's the range within which you can get your work done. We talked about that a minute ago. And not have an increase in fixed costs. So if McDonald's can only serve 1,000 customers a day and they suddenly find that they need to be able to serve more, that's outside the relevant range and their fixed costs will go up. Finally, for exam 1, multiple overhead rate systems. This POR that we've talked about so much, let's go back up to the calculation here. When you calculate a predetermined overhead rate, most companies only have one. That's sort of the lazy way. If you have a system where there are several overhead rates, so multiple overhead rates or multiple PORs, it's a better system because it more accurately defines how costs should be allocated. We spent a bit of time in class as I discussed the fact that the humanities, for example, the English department probably uses the library more than the business and the engineering school. And yet, at the Citadel, we use one application rate because everybody pays the same tuition. So the cost of the library that's mostly used by students in the humanities, like English majors, history majors, then that cost is being spread out over everyone. But then if you were to go somewhere like the medical university, you will pay depending upon what degree you get. And so they use several overhead rates. So how do I suggest you study? Well, I know this is not the most exciting 25 minutes of your life to listen to, but maybe listen to this and find the areas that you find are tricky. Go back in and look at your homework. Please remember that those homework assignments are in the back of your chapter. I'm pretty sure that there's a video that talks about how you can access the homework once you've completed it. I do know that there's a video there that talks about how you can access the quizzes on SitLearn once you have completed them. So you can go back in and see what the solution is. Don't forget to do chapter homework for all chapters and study the terms. That's the most crucial thing you've got. Is if I were you and I were studying, I would sit down and start a terminology list, a vocabulary list for every single chapter in this text. Please let me know if there's anything I can help you with, and best luck as you study.